name is Matthew Littman. I'm a senior manager here at Shemie CPA, where we deliver premium accounting services to real estate investors to help them drive profits and growth. As always, we have our founding partner here, Charles Shemie, CPA, CA, that is here to discuss with me. How are you doing today, Charles?
I'm great. How are you doing, Matthew?
I'm great.
Nice to see you again.
Nice to see you too.
What do you want to talk about today?
Well, today I thought we would cover one of the most important deductions that are available to real estate investors, and that is CCA, otherwise known as capital cost allowance. So I guess we should just start off with explaining a little bit about what CCA is. Could you give me a little bit of information on what CCA is?
Sure. Capital cost allowance, or for short for CCA, is a deduction, like you said, that's available to owners of real estate. You can look at it as a form of a depreciation for accounting purposes, but this is for all intents and purposes, a form of depreciation for tax purposes. And you are able to claim a certain percentage of the cost of your building or your condo or whatever real estate that you have, usually around 3% per year as a deduction. So if you have a building has a cost for tax purposes of $100,000, you'll be able to claim $3,000 as a capital cost allowance against your other rental income that you have to reduce your total taxable income.
Interesting.
That's what it is in a nutshell.
Great. And is CCA, do you have to take that deduction?
No, it's actually it's discretionary. You can decide to take it or not. Usually, there's a downside to taking these deductions because it reduces your undepreciated capital cost balance, or UCC. And in a nutshell, that means that if you're ever to sell that property in the future, all of those deductions that you took will have to be added back to income. So it's a short-term benefit to get short-term relief on your taxes. But if you have intentions of selling it in the future, then that will all have to be added back to income. So it's discretionary. Some people choose not to take it for that reason because they intend to sell it in sell their building in the near future. Some people may never sell their real estate, and their properties have been fully, their UCC balance is basically at zero, and they're okay with it because they have no intentions of selling their property.
Understood. So, if I understand correctly, you have to include the deductions the CCA deductions that you took upon sale of the property later on.
That's right.
All right.
You have to include it as income.
Okay. So under what circumstances would you normally recommend taking this discretionary deduction?
Well, I mean, if you want to, I still recommend to clients to take it as much as possible, unless they intend on selling their property in the very near future. Usually real estate is held as a long-term investment. So I'd rather have the benefit of the tax savings today versus including it in income 10, 15, 20 years from now, including it as income. So I always recommend to take this capital cost allowance to reduce the present tax situation.
Would you say it makes any difference about whether, depending on how you're structured, this decision whether to take your CCA, if you're structured and set up in a corporation versus if you're holding the property personally?
Yeah, it would definitely make a difference. If you held the property personally, first of all, I want to just mention that you cannot create a loss with CCA. So if you have losses in your in your rent as rental losses, you wouldn't be able to increase your loss with a CCA deduction. You can only go up, you can only claim CCA up to the point where your profit is at zero. So, if you held the property personally and you want to reduce your income overall, maybe you have other forms of income, other sources of income, and you want to reduce your tax rates to maybe a lower tax bracket, it would be advisable to take, capital cost allowance on that.
Okay, great. In the States, I know there's something called bonus depreciation. Is that type of deduction available in Canada, like an accelerated CCA?
Not generally for rental properties. No, there is no accelerated type of CCA. If you had maybe factories, manufacturing plants, there are other forms of CCA that you can get that are more aggressive. But
Okay.
for just generally investment type of properties, usually right now it's at around 3%.
Okay. Fantastic. So I think that's it for today. I feel that we've given our viewers a good understanding of what CCA is. And I'd like to thank them for spending time with us and learning more about this interesting topic. Charles, thank you for joining us as well.
Well, it's really great to see you again, and I hope that we gave our clients some valuable information. And
Yes.
please don't hesitate to call us or to contact us in any way, and we can help you out with your projects.
Awesome. So that's it. Until next time, have a good week and happy real estate investing.
Have a good one. Bye-bye.